Hello and welcome to this conversation on BloombergQuint. We've got the gross domestic product growth data for the quarter 3 for the current fiscal year, and what we got was a number which was surprising to the upside. 7% growth is what the CSO has pegged growth at for the third quarter. That's higher than what most analysts and economists were pegging it at. Joining us for a chat on what goes behind the numbers is Saugata Bhattacharya, Chief Economist at Axis Bank. Saugata, thank you so much for coming in.
Pleasure and privilege to be here.
7%, Saugata. Firstly, what's your interpretation of that first number? You had some time to look at the breakups by now.
That's right. But 7% is the GDP. We are looking more at the GVA numbers. Okay. GVA numbers, because GDP involves the subsidies, the indirect taxes, and so on, which, as you know, indirect tax collections have been very high this year. So I think looking at the GVA numbers, again, 6.6. The actual GVA number for the Q3, definitely higher than street estimates, and particularly so from our own estimates at Axis Bank. We thought that it would probably come in lower than 6%. But there are reasons for this. Let me try to break it down into the components where we got it wrong.
Yeah.
So the biggest surprises in the higher than expected numbers were not from the segments that we had a priori thought would have been the segments that would have been affected by this demonetization. So things like construction, real estate, those numbers have actually printed far lower than you had seen in the Q1, Q2 numbers. So those numbers. A little bit of a puzzle is the transport and the tourism transport, that segment, which came in higher. So we need to understand what happened there, because a priori you would have thought that even that would have suffered. The second point is the surprise actually came in from segments like manufacturing, from mining, and a little bit from agriculture. So, taking agriculture first, agriculture probably, and agriculture is directly looking at the output. The way agricultural output is picked up, you actually look at the output produced that comes in from the APMCs, that comes in from the Ministry of Agriculture. So, presumably, what we had earlier seen largely in terms of grain output and so on. So, agriculture is now a very diversified segment. So, the horticulture, the allied activities, the dairy, poultry, etc., that probably would have done a little better.
Okay, but that's the monsoon effect?
That probably is also the monsoon effect.
To some extent.
To some extent, in the sense that we know the effect of the monsoon, so we should have factored this in, so that it came in actually higher than what we had expected, is that little bit of a surprise, but that's okay. Mining was the biggest surprise, because we had expected something like a 1.5% growth. The previous 2 quarters was negative growth in mining. That suddenly came in at 7.5. The presumable explanation for this is the way that mining numbers are computed. So, in the first cut, in the first estimates of GDP, you look at the results, the sales results, the performance of some of the large mining companies for some part of the mining sector index, and these companies, remember, have done very well this time because of the rise in commodities prices. Steel, coal, lignite, aluminum, copper, all of these companies is up. And then when you look at these sales numbers, then you use the WPI to deflate these numbers to the real growth. And the WPI numbers have not risen to that extent. And this is reflected in the difference between the real GDP of the mining GDP and the nominal, the current, in terms of current prices. That's only a 4%, which is exactly what the WPI numbers show. I think so that's part. In the manufacturing segment, that's also fairly high, almost 9% in manufacturing. Growth, and that, I would bet, a large part of that would have come in from the energy companies. The way that oil prices have increased, the refining margins have increased, the GRMs as they are called, for some of the large companies. So
that gets captured in the manufacturing data?
I can bet, we are going back again and looking at our own data on this. I can bet that the large part of the 9%, maybe as high as 5% of that 9% would have come in from the energy companies, and also all the other commodities-based manufacturing companies, the steel companies, the aluminum companies, etc. Even they have done better, because all those, the metals prices, the metals complex, the prices of the metals complex, that has risen faster. So that's the manufacturing, mining, agricultural story. That's the source of the positive surprise. The last part in all of this is the government expenditure, which is the public services, etc. So half of that is government expenditure, half is personal expenditure. Government expenditures we know, because that the centers numbers we track, and even the states, to a certain extent we get a sense of how much the states are spending. So we knew that the government expenditure for the Q3 quarter, the third quarter, had actually risen by 20%, which is exactly what the numbers seem to suggest.
Yeah.
That the 12% numbers that we are getting. So actually, I mean, if we now, I mean, post the analysis, ex post, when we are looking at the numbers, some part of this is some puzzlement in maybe how come, I mean, with such a large economic shock to the system, the economy has proved so resilient.
Yeah.
So now that we go back to our ex-ante analysis, I think there is a significant part, maybe not 100%, maybe there's still about 30%, 40% which still remains unexplained. Okay. But a large part of this is actually the way that the GDP numbers are calculated.
And so you might, commodity factor.
That's right. So you might argue that this is not reflective of actual output growth in the ground. Okay. But hey, I mean, this is the way
the number has always been computed, so we have to stick with that. Okay, so we've understood the manufacturing number, we've understood the mining number. Things like construction, etc., they've taken a hit compared to last quarter, but it doesn't show like it hasn't come to a standstill, right?
Yes.
I mean, so that is telling us what? That maybe the assessment of the impact on these, of demonetization was not correct, or is it that it's not been captured yet? Some part of it?
I would presume that some part of the higher than expected construction numbers, say for instance, maybe real estate has actually been hit. Maybe real estate has actually been hit. This construction, the better than expected, let's say, although not great numbers, would probably have come in from infrastructure construction, because I mean the pace of road building activity has gone up, a lot of civil works, urban metros and things, which we don't have access to that data which the CSO presumably has. So I think those parts would have been some part of a countervailing influence on construction that would otherwise have dropped from the real estate segment.
Okay. If you look at the expenditure side numbers, the personal consumption numbers, the fact that personal consumption growth was still at 7.2%, right?
That's right.
So did that surprise you?
Personal consumption is actually 10.
It's 10, is it?
10%.
Okay.
10%. Okay. So that's a surprise. But again, I mean, if you again come back to whatever, we don't understand that. So might it be the case that consumption, we know that, I mean, whether it be internal bank data, whether it be anecdotal data, consumption has actually dropped. I mean, initially in November, definitely there was a hit on consumption. It recovered to a partial extent in December. So might it be the case that the consumption numbers in the month of October and immediately after Diwali in early November actually might have been better this time, coming in either from the effect of the 7th pay commission payouts during the festival season, and the better than expected, better earnings in the agricultural sector post the better rains, etc. So I mean, some part of that might have come in the initial months in October and early November. That might have led. I'm not saying this is a very plausible explanation, but that's something that's worth exploring in detail now that we have the numbers.
Okay. And the other segments there, government final consumption expenditure is also high, but that's been high for the last 3 quarters, so there's no surprise there.
And that is exactly what is showing up in the public administration. And
there's a little bit of a rebound in the fixed capital formation numbers, but that's just a very slight turn from negative to positive. Nothing
and positive, and that probably reflects all the road building activities, the urban infrastructure activities, a little bit on power transmission, etc. So those are the ones that might have. But other than that, I mean, the actual numbers that we had seen, I'm not very sure. I mean, the Q2 numbers that we had seen for fixed income, fixed investment, that was down to 0.
Yeah.
So I'm not very sure what exactly has gone up in the quarters. But remember, the other part that you need to be very careful in looking at the growth numbers is that this is not just the numbers for Q1, Q2, Q3 of FY17, but all the numbers for FY16, FY15 have also been changed, have also been revised.
Yeah.
So we need to look at those numbers in addition, how much of those numbers revisions might have led to some of the increases there. So it's a complex exercise, but we're just trying to figure out what is the real growth picture underlying some of these growth rates.
Okay, and in assessing that, you definitely have to take into account the commodity factor, as you clearly pointed out.
I think that
has to be.
Whatever growth you've seen in manufacturing, in mining, maybe in some service segments as well,
related to that commodity space.
Related to the commodity space. In addition, in services, you'll also have to factor in the growth rates of the IT companies. They have also done fairly well, much better than the other services sectors because of the drop in the currency. This was the period when there was a slight, when the rupee had dropped slid against the dollar. So that would have added to the rupee revenues of the IT companies.
Okay. Just a quick word on the full year numbers. So they haven't changed the estimate for the full year numbers, right?
They have.
7.1. I mean GDP again. I'm looking at GDP. So
GDP is pretty much the same. GVA has come down.
So those numbers, I mean,
6.8, I believe.
Yeah, so I mean, they're not way out of what the RBI has suggested.
RBI has 6.9. The initial estimates was 7.1. So I mean, the point is that the slowdown had started even before the demonetization. And that is what the worry is. That despite the government has actually tried to do a lot, whether it's with the state governments, whether it's with the centre. So despite that, despite good rains, even before the demonetization in Q2, things have started to, that momentum that had been built up, that momentum seems to be slacking. I'm not saying that this is going to persist forever. All indications are some of the actions that the government has taken would probably begin to fructify in not just in the fourth quarter in FY18. So maybe there's still enough growth momentum left for the system to move up from these levels. But some part of the presumed growth slowdown, not the monetization exercise, but the growth slowdown, the inherent growth slowdown, I think those issues need to be addressed.
So what are your numbers for this full year and next year then, next fiscal as well? What are your estimates?
I would think initially we were at about 6.6 before this. So going from 6.6 to the CSO estimate of 6.8 is no great shakes. So presumably I'm going to agree with the 6.8 numbers. The interesting thing is, I don't know how this will play out. So remember, this monetization thing came at the middle of the quarter. So I mean, in manufacturing, I'm sorry, in manufacturing, a lot of the manufacturing thing would already have been planned. So and you would have seen this in the inventory numbers from the demand side. Inventories have gone up. So some part of the inventory might lead to a production slowdown in Q4. Although the PMI numbers suggest that things have picked up. Things actually did badly in November and even worse in December, but the January numbers were much better. So I'm not sure whether that story is going to play down as well. But maybe what we had thought would have happened, the slowdown that we had thought would have happened in Q3,
there could be some spillover
into Q4.
Okay. But given this scenario and given the numbers we have so far, the RBI is justified in the stance that they have taken on monetary policy, because then there's no real growth issue that they need to address. And if the core inflation numbers are looking sticky, then they're probably justified, no?
Look, so even if at the end of the day, after your number crunching, post the GDP numbers, you finally decide that output has indeed slowed down, I think the RBI more or less, we had expected a hold in policy. We hadn't expected this change in stance, the change in stance. I think to a certain extent they were justified. I do think the risks of reflation have really risen much more than we had earlier, probably in their judgment at least. It's risen much more. Job of a central bank is to anchor inflation expectations. The rupee has been remarkably stable. Hopefully it will stay that way, and large part of the reason the rupee had remained stable is foreign investors' view on inflation in India. That's the nominal anchor that the RBI and the monetary policy keeps on talking about. So I think it's best at this point in time to have made a little bit of an adjustment. This doesn't mean that they are going to, this is like the ratings outlook. You first change the outlook and then you change the ratings. So I think they're justified. And at the end of the day, it doesn't really matter whether RBI cuts another 25, 50 basis points. I think rates have already come down and they're beginning to feel like an automatic stabilizer in the sense that till growth comes up, till credit growth improves, demand for credit improves, I don't think you're going to see an increase in interest rates anyway. So actual market rates have done the job for what the Reserve Bank of India would otherwise have had to do.
That's a fair point. Saugata, thanks so much for this conversation.
My
Good to
pleasure,
understand the GDP data from your perspective. Thank you.
Thank you.